Hey guys, Marcel Leblanc here, Certified Financial Planner, and welcome to OnVisor TV. Now today I'm going to answer one of my followers' questions, and he asks, how are my investments taxed? Now presuming you're investing outside of a TFSA, tax-free savings account, or an RSP, registered retirement savings account, the investment returns that you earn on a non-registered account are taxable. The TFSA and the RSP have tax preferential treatment, which either eliminates or delays taxability. Now, one of those two is probably where most people should start investing, but let's presume for a minute that you have investments outside of an RSP or a TFSA. So remember that there's two kinds of money that exist for most individuals. There's pre-tax money and after-tax money. And pre-tax money is typically income that hasn't been taxed yet. So as soon as you have income, such as a paycheck, deposited into your bank account for you to spend, which becomes after-tax money because your employer usually pays the tax for you, that income is taxable. But once the money is in your bank account, it becomes after-tax money. And if you take after-tax money and invested in something that generates investment income, that becomes income all over again. So it's income that has to be tagged on top of what you've earned while working or running your business. Now there's three kinds of investment income that you can generate. The first one being capital gains. Now capital gains is when you buy something or an investment for $100 and you grow it to $500, while there's a $400 difference between the price you paid for it and the price you sold it. Half of that $400 gain is taxable. So you would add $200 to your total income for that year when you're filing your taxes. On the year that you sell it. If you're still holding it, you shouldn't have to pay taxes unless the tax code changes in the near future. The second type of investment income you can generate are dividends. Dividends are essentially when it's your share of the profits that the company chooses to give back to you. So if you're investing in company, either publicly traded company in the stock markets or private companies that are local, that company can choose to reward its investors either quarterly or annually or whatever they choose to. They can kick back a part of the profits for the year and give those back to their investors as dividends. Now there's two kinds of dividends that exist. Each gets a different tax treatment, but serve it to say when you're receiving dividends, you will be taxed on those, and there's some kind of tax credits that makes that tax liability a little bit more bearable, but it depends on your situation, your level of income, and the types of dividend you're receiving. Now the third way is interest income. Interest income like the one you receive through a regular bank account, GICs, or even if you're lending money and you're earning interest, in some ways that might be possible, but typical general interest income. Now, interest income is literally just considered income. There's no 50% rule. There's no real special credit to make it, to ease the pain. Interest income is interest income. Now, the neat thing about earning investment income is that it can be offset in certain circumstances. So, capital gains can be offset by capital losses. Investment interest can be offset by investment costs that you had to pay to incur the interest. Perfect example would be real estate. Real estate, your rental income is taxed the same way as interest is, but you can write off your snow removal and the interest you pay on your mortgage and other expenses you might have to incur, right? And dividends, again, you have those tax credits that can help you as well. So those are the three main ways that you can get taxed on your investment income. Again, and once you've paid those taxes, the money that's left over is yours to spend or reinvest freely. So hopefully this was valuable for you. If it was, please feel free to share. Until next time, cheers guys.